The German industrial production is still weak. We still see weak orders in PMIs in the German industry, and Germany is already in a technical recession. So, in my view, this is still something that you need to watch out for in terms of asset allocation. That Europe is not the place to hide. Also, should energy prices start to reaccelerate, then Germany and Europe in overall will be the last place to hide, essentially. The signals are telling me not to buy energy despite the Russian turmoil. Welcome to this live edition of Steno Signals. My name is Andreas Steno, senior host here at realvision, but also the founder of Steno Research. And I've brought Mikkel Rosenvold with me today, also to discuss the developments in Russia over the weekend. Mikkel is the head of our geopolitical research department here at Steno Research, and obviously follows the developments close in Russia. Mikkel, let's start with the big question here. What's the current status in Russia, and what will happen next after this failed rebellion by the Wagner group?
Yeah, so as you guys probably know, on Friday and Saturday, we thought we had a civil war in Russia on our hands. So this was a really big issue. What happened was essentially that Prigozhin rebelled against the leadership of the Russian defense, and eventually, as you know, he struck a deal with Putin. So now he's going to Belarus, and things are more or less going back to status quo in Russia. At least that's what both Prigozhin and especially Putin will want it to seem like. So during Saturday, we were very much focused on this also with regards to the markets, because the area that Prigozhin initially advanced into, the southern parts of Russia, is the main shipping area for liquefied natural gas, but also for a lot of the grain exports out of Russia. So that could have had huge implications for global markets. Then, of course, it was probably lucky that it all happened on a Saturday, so it didn't impact markets live, and it was all resolved on Saturday as well. So now we're looking at a situation where the Russian military and the Russian state has complete control over its territory. So the natural gas is flowing, as far as we know, out of Novorossiysk. The grain is flowing. The grain deal with Turkey and Ukraine can be renewed. So we are pretty much back to status quo, although perhaps on the slightly longer term with an increased risk of renewed turmoil within Russia.
Yeah, I think that's a fair summary of the situation in Russia. And I'd like to show a few charts in relation to the current backdrop when it comes to the commodity markets, also given this turmoil in Russia. We've actually seen sort of a stabilization in commodity markets over the course of May and the early parts of June, in contrast to what we've seen over the past couple of quarters with a clear bear market in commodities. Just south of 50% of commodities have actually increased in price over the past 30 days. That's quite an improvement from earlier stages this year, where we had a clear bear market across more or less all commodities. But we're yet to see a majority of commodity asset classes performing relative to asset classes within the commodity space, declining in value. So I think it's fair to still define this as a bear market, even though we've seen a few signs of stabilization. And given that we don't have that smoking gun in Russia right now, at least, I think it's safe to say that the Russian situation, unless we get a trigger, will not prompt another bull market in commodities. If we look at the various commodities and the performance over the past month, I've tried to sort of summarize them in a bar chart from the best performing commodity to the worst performing commodity. And actually, it's quite interesting that a couple of the commodities very clearly linked to the situation in Russia and Ukraine have declined in value over the past 30 to 40 trading days. Here I'm talking about European natural gas. First of all, you see that to the very right of the leaderboard here, but also the price of wheat. And on the other end of the leaderboard, we have, for example, copper. Copper has made a remarkable comeback through the latter part of May and into June. Likely as a consequence of all of the attempts from the Chinese authorities to sort of refuel the economy. They've given us a lot of hints of upcoming stimulus. We're yet to see sort of the firm evidence, but copper is at least leading the way on this renewed Chinese rebound after a bit of a roller coaster on that story over the past, say, 3 or 4 months. But if we look at the price of natural gas and the ties to what's going on in Ukraine and Russia, natural gas prices actually spiked midway through the month of June or the early parts of June, related to news out of European politics, actually. It also carried spillovers to the price of natural gas in the US. The main index, the Henry Hub index, is actually up on the month in the US after the Dutch politicians decided to end the Groningen gas field ahead of time. So we now know that the Groningen gas field will close by the end of 2023, just ahead of New Year's. And it is, at least from what we know as of now, the biggest gas field in continental Europe, probably even close to being the 10th, among the 10th biggest gas fields across the globe. And I'd like to get your take on that decision as well, Mikkel. It led to a spike in natural gas prices. We've seen a retracement in Europe, but not in the US on the back of this, because obviously if Europe continues closing local gas fields, they will have to import it from elsewhere.
Absolutely. I mean, if you want to understand European politics and how it differentiates itself from American or Chinese politics, look no further. I mean, this is a very good example. So basically, you had a huge gas field that was opened a couple of decades ago, was a symbol of Dutch pride, basically, to be able to make their own natural gas. But on one hand, the gas field was running out. There was no desire to dig deeper. It was already planned to be phased out. And on the other hand, you had a lot of earthquakes that was a result of the gas drilling. So this was obviously a very large or a big subject for the local population, or a lot of dissatisfaction, even though it's not a very densely populated area of the Netherlands. But this was a big issue politically, and eventually the decision was made to close it entirely. The gas field still had about a year worth of Europe's total natural gas consumption in it. So which would have, strategically thinking, would it be really, really nice to have around? But that's not the way local politicians think, of course. This is a decision that baffles or mystifies a lot of non-European countries. But this is the sort of decision you should expect from Europe. Yeah. I mean, the decision is very clear to move away from fossil fuels, even though we are still, and when I say we, I mean Europeans, are still completely addicted to natural gas. So that's sort of the situation.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
Yeah, and if you look at the gas production in Groningen, we have a chart on the running production from the gas field. And it is also very clear when you look at it visually that it's been a gas field that has sort of abated in size relative to the consumption in Europe over time. But still, it had a lot of resources left. And the initial plan was to close this gas field between 25 and 28, and they've moved that date forward to this year. A strange decision, if you ask me. Why not just keep this option open? As soon as you close this, it is the point of no return. You're not able to reopen it. So this is another almost suicidal energy policy decision from the Europeans. But I guess they've been tempted by the decline that we've seen in prices, by the slightly more benign scenario in Ukraine compared to a couple of quarters ago. And therefore, this will not be reversed, this decision. I can almost surely guarantee you that. And it's very visible when you look at European liquefied natural gas consumption relative to piped natural gas consumption, that we've changed the strategic course massively over the course of just a year and a half here. If we look at the most recent set of annual numbers, we actually now see a larger import of natural gas from liquefied natural gas compared to piped natural gas, meaning that the destinations of import now stem from everything from the US to Qatar to such countries, right? So it is a major shift geopolitically from Europe as well. We're now much more dependent on the US and the Middle East in relation to this natural gas conundrum relative to just 1.5 years ago, where Europe was basically more or less solely reliant on Russian energy. And I still think it's a major issue for example, the German industry. We keep getting terrible numbers out of Germany. The German industrial production is still weak. We still see weak orders in PMIs in the German industry. And Germany is already in a technical recession. So in my view, this is still something that you need to watch out for in terms of asset allocation, that Europe is not the place to hide. Also, should energy prices start to reaccelerate, then Germany and Europe in overall will be the last place to hide, essentially. But if we look at the current situation, I guess this is also the major reason why this decision was taken on the Groningen gas field. Europe is actually running ahead of schedule when it comes to refilling or replenishing natural gas storages. The plan is to have natural gas storages 90% filled by 1st of November. And the vertical line here signals sort of the weekly threshold that Europe needs to meet in order to be able to fill natural gas storages ahead of November 1st. And as you can see, most weeks so far this year, Europeans have been able to sort of outpace this minimum threshold. So that is also the reason why prices have declined, and they will likely continue to decline as long as we see a picture like showed on the chart here. And if we look at it relative to last year, where we had this complete mayhem in European natural gas markets, it is also very visible that the Europeans are ahead of the 2022 schedule when it comes to refilling these natural gas storages. The monthly flow into storage has exceeded 2022 levels on a running basis throughout January, February, March, April, May, you name it. And it still seems to be the trend that the 2023 pace is higher than it was in 2022. So as of now, it seems like Europe is in a much better spot relative to last year. And we can show it when we look at the aggregate natural gas storages relative to a year ago or a couple of years ago. I have a chart on the running fill level of natural gas storages in Europe since 2017 on the next page. And as you can see, the drawdown over the winter of 22, early 23 was much smaller than usual. The winter was hotter than anticipated, and Europeans simply needed less energy, alongside a lot of people voluntarily deciding to use less energy than usual. Voluntarily is probably not the word here, given the price level. Some obviously were also forced to take that decision. But in any case, the storage levels look relatively benign compared to basically most neurohistory, and Europe will reach target ahead of time. The issue here is that natural gas storages, they're not enough to cover the entire energy need for a whole winter. So in case of an extreme winter, in the sense that it turns out colder than usual, we will probably end up with much higher prices anyway in Europe. But at least the starting point is much better than it was a year ago. And that is the ultimate reason why energy is not a buy currently in Europe, because there's no rush basically to buy more energy, because storages look much more benign than they did a year ago. And the other side of the coin when it comes to liquefied natural gas is China. And the Chinese consumption of liquefied natural gas was expected to be elevated throughout 23 in conjunction with their reopening. But if we look at the Chinese imports of liquefied natural gas relative to trend, it still looks like the Chinese reopening, at least from an industrial perspective, is not really firing on all cylinders. The red line here is the 5-year trend, and the imports are still below trend this year so far, which is a surprise to many, given that China is now fully open, obviously, but they simply struggle to get the orders book filled up. And that is the issue for the Chinese industrial complex. They struggle to get the orders back due to the perma-lockdown and the lack of credibility that they had throughout the COVID pandemic. And if we look at the ramifications for oil markets and broader commodity markets, I think this Chinese story is the one to watch. The Chinese momentum is not there when it comes to energy commodities. The momentum is slightly rebounding when it comes to industrial metals, but not energy yet. And we can essentially see it when we look at import data on liquefied natural gas. What I have on the next chart here is a picture of European imports and Chinese imports. And what you should note on the left-hand side is that the Chinese imports are on a reversed scale. So when the dark blue is above zero, it looks like it's above zero. It actually means that there is a drop year over year in the amount of imports of liquefied natural gas to China. And we are still stuck with a decline year over year in Chinese imports. That is a puzzle to many, and it's especially a puzzle to a lot of the energy bulls out there that China is not firing on all cylinders. And if we look at the oil consumption in China, we essentially get almost the same picture. This is a chart on the annual import of oil in China, and as you can see from 2023, we've now entered a path of a slight rebound relative to the last few years, but only with a small increase relative to the peak that we saw in 2020. So China actually had a declining consumption of oil through their perma-pandemic lockdown, which obviously makes sense given the lockdown. But even now on the other side of the lockdown, it's not like they're not using a whole lot more energy, which has caught a lot of oil market commentators and traders by surprise. This is almost the status quo relative to before the pandemic, and it is very visible from these import data that China is struggling to get the manufacturing and the industrial cycle back after the pandemic. And when we look at the US side of the equation, I think inventories, they still look relatively low, but they're actually faring better than feared if you look at it over the past few weeks relative to what you should expect seasonally through May, June. And we're stuck at levels where we have broadly sideways action in the inventories in the US, despite the Biden administration still releasing a decent amount of barrels from the Strategic Petroleum Reserve. And currently, we're kind of stuck in this interesting war between the Biden administration and the Saudi Arabians when it comes to this oil market, with the Biden administration continuously pushing oil to the market when the Saudi Arabians try to limit the supply. And I think the situation is currently stuck at sort of a knife edge since the OPEC Plus group struggles with compliance, and Russia is clearly an example of that. And I'd like your take on it in just a second, Mikkel, because I want to show one chart on Russian seaborne exports of oil. The Russians were part of this supply cut deal, and they're still a part of it, but they're accused right, left, and center within the OPEC Plus group of non-compliance with their quotas. And as you can see from data that we can actually track very neatly, we've actually seen an uptrend in the amount of barrels exported via sea on a weekly basis. We've seen a decline in the June data. I think that's related to what happened this weekend, but on a trend basis, we're still trending upwards. So the Russians are not complying with the OPEC Plus group targets. So how do you view this situation, Mikkel, in OPEC? Is Russia not playing ball with the Saudi Arabians here?
No, clearly not. I think Russia's exploiting some of the internal divisions within the OPEC spectrum. A lot of the countries disagree with Saudi's view. Perhaps the Russians have some sort of unstated clause that that they're allowed to sell this oil to China, because China is I still see China as the pivot of many of the decisions made in OPEC. We know that the Chinese oil consumption, as you showed, has been lower than expected, which makes the Chinese less vulnerable to higher oil prices. And also doesn't help drive up oil prices as the Saudis would have hoped. So I think they're probably the pivot. It's quite honestly astonishing that the Russians are still keeping up their oil production with the massive Western embargoes and blockades. They're still getting their oil out there. They're still helping the Chinese a lot, especially, and that still surprised me to this date. But clearly the Saudis are very alone in this, and the net result has to be that the Saudis are losing market shares.
Yeah. Indeed, and the Saudi Arabians will limit supply from July and onwards in a standalone action, actually, from the Saudi Arabian authorities. It is sort of a deal on top of the broad-based supply cut within OPEC Plus. We have a question coming in on Russian natural gas and where Russian natural gas is flowing. The answer to that question is that some of it, we're able to track some of the flows, but the rest of the flows are tricky to grasp, since the embargoes and sanctions and all that stuff makes the sort of black market for the Russian natural gas relatively large. But we know that pipe natural gas is still flowing via Turk Stream to Turkey and that area. We also know that there is still a decent flow through the old Brotherhood pipeline through Ukraine, despite the war ongoing. And there is also a pipeline from the gas fields in the very eastern part of Russia to China. But the flows from the very northwestern part of Russia, relatively close to where we're situated, they're basically more or less gone, unless they're managing to ship these flows via a very, very long sea route from there, and essentially that is not really feasible to any major extent. So if you go out there in the Bering Sea, you will actually see flares of the sea bed because of the gas just being burned to a very large extent. So the Russians still sell natural gas where it's applicable and where it's feasible, but the flows are mainly to Turkey via Ukraine and also to China. And if we look at our price projections for natural gas in the context of this situation, we have a natural gas model based on very thorough weather forecasting, not our own weather forecasting. And on top of that, we measure the ongoing supply-demand balances via the storage situation, but also via these running flow data series from both Russia and other gas-producing nations. And we've actually now at the point where the model gives us very close to 0% probability of rising prices. You should always be careful of stating that there is a 0% probability of rising prices. It could be the famous last words, right? But from a probabilistic perspective, the natural gas market doesn't look ripe for another rebound here, given the stubborn storage situation, and given that Russian flows are probably better than feared. We're just not able to measure them to the extent that we'd hoped for. And on oil, we get a slightly more upbeat picture when we look at our probabilistic models, but we still have a net bearish outcome also on our oil models. The dark blue line here is a running model based on the oil curvature, the inventory momentum across the globe, but also weather-related forecasts. And it sums up the oil market to a net bearish situation as well, currently with a roughly 35% probability of rising prices. So even though the supply situation looks a bit tight, given what Saudi Arabia plans on doing from July 1st and onwards, it is still not enough to tilt the situation in their favor currently. And this is the final thing I wanted to mention today. There is a clear tug of war ongoing between what I call oil market speculants and the Saudi Arabians right now. And typically, when I see extreme betting against a commodity, so a lot of short selling of oil contracts, as we see currently, I would argue that it should be seen as a contrarian signal that everyone is trying to sell the commodity and the price is not reacting. Maybe you should go long on such a signal. But the issue here is that the Saudi Arabians struggle with non-compliance from other OPEC Plus members. And if the short sellers manage to squeeze the price a little bit in the direction of lower prices, then the non-compliance will increase. So they can actually spur a reaction from the member countries, because if prices decline, a lot of members will have incentives to increase production. And we know that there is spare capacity out there now compared to just a few quarters ago, meaning that the positioning that we see at the very top of this positioning table with a clear short in crude oil is a very live example of what I call game theory in actual asset markets. This is speculants trying to force OPEC Plus into folding and into producing more. And currently they have the upper hand as far as I can judge. And I'll conclude the slide deck of the week with a chart on the Saudi Arabians relative to the oil market bears out there, because it's clearly a war between those two counterparts right now. Oil market bears currently being backed by Joe Biden and his administration. And Mikkel, if you were to judge, how close is Saudi Arabia to caving in to the pressure from markets here?
Not that close, I think. I think there are two factors. One is how big a market share can they stomach to lose? Because other countries, Nigeria, Angola, the UAE, are still producing at more or less usual levels. So they're eating the market shares that the Saudi Arabians are leaving out there. That's one thing. The other thing is, how long can they wait for the Chinese markets to get going, or the Chinese production sector to get going? Because if the Chinese get their economy up and running, they will be consuming more oil. They will be forced to buy not only the Russian oil, but also to buy more in the world market, which will push prices upwards. So I think the Saudis will try and stay their course and hope for the Chinese economy to get going, basically.
Yeah. We have a question from Ralph in relation to the correlation between the TTF natural gas price index in Europe and the Henry Hub natural gas price index in the US, whether there is a strong correlation or whether we should expect diverging trends in the two indices. And I think this is a very great, good question, because I actually wanted to mention that the Henry Hub index is much more likely to increase in price relative to the European TTF index. The TTF index is still much more expensive than the Henry Hub index, meaning that for say 1 joule of power, you simply pay more in Europe than you do in the US. And therefore, when we continue to close down production fields and production sites in Europe, we will need to buy more Henry Hub gas, to put it a little bit simple. And I think that's why we've seen the divergence over the past couple of weeks with slightly higher prices in Henry Hub and the price decline in TTF at the same time. And this gap could close from above. So being long Henry Hub and short TTF natural gas, if you're able to trade that spread, seems like a plausible bet to me. Other than that, question about the price of oil and natural gas in 2024. We've talked a lot about the short-term outlook here. And my impression is that the current lack of demand is very related to what I call the global industrial cycle. China's industry is not performing. Germany's industry is not performing. We also see signs of weakness in US manufacturing. So all major manufacturing hubs throughout the globe suffer from a lack of demand currently from end users, while the services sector still remains much more in much better shape than the manufacturing sector. So when we get that rebound in manufacturing, and I still think that we're, say, at least a quarter or two away from that, that is the point in time where you should really start to worry about higher energy prices again. As soon as China's manufacturing sector is up and running again, And as soon as we get the spillovers to German manufacturing and US manufacturing, then oil prices and natural gas prices will likely rise again because the supply side is constrained. And we're not getting any supply side positive news out there. The only reason why we've been on the bearish side of this trade for a while is the demand side. And as soon as we see the demand side picking up again, then we are very willing to turn around on this view and enter into long bets again. But we'll stay on the short side, especially in the European side of this trade. So European natural gas prices will likely decline further, while there's a greater possibility of higher prices in the US. And oil markets, they still look soft to me. And it seems like the speculants, they have the upper hand against the Saudi Arabians. Let's see through July. But for now, the Saudi Arabians, they seem to lose this battle. I think we will leave it at that for this week. Remember that we have an exclusive offer for the Real Vision community. If you'd like to follow our price models on a daily basis, you can go to stenoresearch.com and get 40% off. If you're a Real Vision member, just use the coupon code RV40 to get 40% off your subscription. You'll find more of Mikkel's and I's work in there, and the rest of our team. Other than that, let me remind you that this is just a window into our thinking, our methodology, and our trading horizons, etc. So we cannot guarantee that we will match your risk appetite or your risk horizon, but what we can guarantee is that we will be back again next week with more from the global macro landscape. Thank you for watching from Andreas and Mikkel.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.